So here's the thing. Every news channel in America is quoting you a percentage this week, and it's 6.66%, the highest in a year. And none of them can tell you what that actually means for a house in Parma, Lakewood, or Akron. So today I'm going to do what the national headlines won't. I'm going to take an actual median priced home right here in Northeast Ohio, and I'm going to go straight to our local Realtor Association data, and I'm going to show you exactly what today's rates cost you in dollars per month on that house. And I'm going to tell you something most buyers have never heard. The Federal Reserve, the thing everyone watches on the news and talks about, is not what sets your mortgage rate. Something else does. And once you understand what that something else is, you'll stop waiting for the Fed and start watching the thing that actually is going to move your payment. I'm Realtor Rich Ganim, and I sell real estate right here in Northeast Ohio. Let's jump into the numbers. And before I do, if you haven't hit subscribe yet, do that, because every single week I share a video just like this about what it's like to buy or sell and live right here in Northeast Ohio. So as of this week, the average 30-year fixed mortgage nationally is sitting at about 6.66%. That's a Freddie Mac latest weekly survey, and it's the highest we've seen in about a year. A few weeks ago, we were down to 6.46%, so rates have drifted up a bit, not down. Now, some of that has to do with what's going on in Iran, of course. But here's the thing. When that number moves 0.2 of a point, the average buyer today shrugs. Sounds like nothing. 6.5, 6 2/3. Who cares? The answer is your lender, and your monthly budget cares. And in a minute, I'm going to show you exactly how much that nothing is actually going to cost you on a house right here in Cleveland. But first, the part of the video I want you to understand and remember the most. The Federal Reserve doesn't set your mortgage rate. So when the Federal Reserve meets and the news comes out that says the Fed cut rates or the Fed held rates or the rate went up, everybody assumes that mortgage rates follow. And for the most part, they don't. So here's the plain English version of what that actually means. The Fed sets one rate, and it's the rate that banks use to charge each other to borrow money overnight. One night, your credit card and your car loan feel that pretty quickly. But a mortgage isn't overnight money. A mortgage is 30-year money. And 30-year money follows a completely different market. It follows the 10-year treasury bond. Think of it like this. When you get a mortgage, an investor somewhere is essentially lending you money for decades. And before they do that, they ask one question. What could I earn just lending money to the US government instead, risk-free? That's the 10-year treasury yield. And right now it's about 4.6%. Your mortgage rate is basically that number plus a markup, usually somewhere around 2 points, give or take. Because you, no offense, are a little riskier to lend to than the United States government, plain and simple. So a 10-year around 4.6% plus the markup, and there's your mid-sixes as a mortgage rate. The math checks out in the real world. But why does that matter to you? Well, it matters because the Fed can cut its rate and mortgage rates can go up anyway. It's happened before. I think in 2024 is when it happened. The Fed cut and rates rose. Not because the bond market was worried about inflation. The bond market moves on inflation expectations, government borrowings, global events like Iran. This summer we've seen it, right? Bouncing oil prices, gas prices even were affected, and it's the situation in the Middle East. So your takeaway in one sentence here is this. If you're waiting for the Fed announcement to time your home purchase, you're watching the wrong scoreboard. The 10-year treasury is the scoreboard that you should watch. When inflation news comes in cooler than expected, that's when mortgage rates fall. No Fed meeting required. Okay, so the house in Euclid. What does 6.66% actually cost here? Let's bring this home. So according to the Akron-Cleveland Association of Realtors, that's our local MLS data for Cuyahoga, Summit, and Portage counties. The median sales price in June of 26 was right around $255,000, which was up 2.4% from a year ago. Year to date, the median is $235,000. So that $255,000 house, which for this example is a 3-bedroom colonial in Old Brooklyn or a bungalow in Cuyahoga Falls, that's right in the middle of our market. Half of everything that sold for less. Now watch what the rate does to that house. Say you put 10% down. you're going to end up financing about $229,500. At today's 6.6% rate, your principal and interest is roughly $1,475 a month. If rates drift up another half point to 7.16%, you're now at $1,552, which is a $77 jump more a month. If rates fall a half a point to 6.16%, you're at $1,400 a month and you save $75 a month. And if we ever see the mid fives again, let's just say 5.66%, that rate drops to $1,326 a month. So the entire realistic range of where rates might go over the next year moves this house by about $150 a month in either direction. On the median Cleveland house, a half a point is roughly $75 a month, which arguably is a utility bill, right? Like it's not a life change. But let's stretch this out. 1 full point on this loan is about $149 a month. That's $53,000 across 30 years. Now that is real money, not just a wait 5 years and pause your life kind of money. But one more number, because this is the one lenders actually use against you. At 6.66%, we have to include taxes and insurance in this number as well. You're looking at roughly $1,900 to $1,950 a month, all in on that median house. And you'd want a household income somewhere in the low $80,000 range to qualify comfortably. At 6.16%, that rate drops to the high 70s. Right? So it's at 6.16%, that income is going to drop to about, high $70,000, somewhere in there. So a half a point of rate is also a few $1,000s of qualifying income. That's why some buyers got pre-approved in April and felt squeezed in July when they actually went to purchase because finances changed. And this is where Cleveland is quietly one of the best stories in America. Handedly. You can Google it. Run the same 10% down math on a median house in a $450,000 metropolitan area, and that payment swings hundreds of dollars per month. Our affordability here in Northeast Ohio is the cushion. Rates are going to hurt everywhere, and they do. And honestly, they just hurt less here. We get a little less pain and a little bit more snow and a crappier football team. What smart Cleveland buyers are doing right now, and it's two things. First, they remember the numbers that don't wait for rates. Remember, according to the Akron-Cleveland Association of Realtors, prices are still climbing, up 2.4% year over year, with only about 2 months of inventory. If you remember, a balanced market is 5 to 6 months of inventory. So we are still very much in a seller's market. So the wait for rates to drop plan has a cost. And if rates fall meaningfully, buyers flood back in and the market gets tight again and prices go back up. You can win $75 a month on a rate and lose it all and more on the price. There's that marry the house, date the rate. Buy the house now and refinance when the 10-year gives you some room. A lot of people, I recommend, if they can, buy the house at today's price and today's rate, and then when rates come down, refinance, and you still have today's rate, or today's price rather, you would still have today's price, but tomorrow's lower interest rate. The second thing is watch the right scoreboard. Stop following what the Federal Reserve is doing. And if you want to follow mortgage rates, watch what the 10-year Treasury bond is doing and watch the monthly inflation reports. Cool inflation numbers and a 10-year drop, mortgage rates will follow within days. That's going to be your refinance angle. And I'll be honest, nobody can tell you when that day comes or is coming. Not me, not the Fed chair, not your dad, not your mom, not the news anchor, not even the mortgage lender, which is exactly why you buy the house, not the mortgage rate. Because for the same person, they're willing to have a 25% interest rate on their credit card, but they're not willing to have the interest rate on the house that they want to live in. I don't understand that math. And if you're trying to figure out what today's rate means for your budget, not the national median, your average price range, your average down payment, that's a 15-minute conversation, and it's exactly what I do. I'd be happy to have that conversation with you and connect you with the local mortgage representative that can explain the exact situation that you're in to you so that you understand it and it's not clear as mud. If this was more useful than another news headline, do me a favor. Like this video, hit subscribe. Because again, I make this kind of groundbreaking level stuff every single week about living in Cleveland. I'm Rich Ganim. I'll see you on the next one.